Greetings, everyone. We are back with a video blog. So the most asked question that I've received over the last week or so has been on the debt ceiling. And I wish I didn't have to make this video. In my opinion, this is a dysfunctional circus that we've dealt with before. This is not anything new. I believe since the 60s, the US has approached or breached the debt limit something like 70-something times. So this is unfortunately part of life, especially in the dysfunctional world of politics in Washington, D.C. So I'm going to walk you through what we think is likely to happen. And we can turn the page back to history. In 2011, a very similar episode happened. So we're going to unpack what happened with equities, if there was any places to hide, any lessons that we learned from that experience, and then wrap it up with, again, what we think is likely to happen. So with that, I am going to share my screen. And as you can see, unpacking the BS in DC. I hate to be crude, but that's what it is. And let's get to it. So first thing is, I'm not going to dive into the politics. I'm neither left nor right. And I think it's good to be objective, especially when you're making investment decisions. So one of the themes that we've said in the past is it's fine if you want to follow the political game or brinksmanship or whatever you want to call it. It becomes a problem when you have biases and blind spots and it leaks into your investment portfolio. So I'll start with that. Looking at where we're at from a fiscal standpoint, this has very much been a team approach. This is not a left or right problem. This is a team effort in getting to where we are currently at with the fiscal recklessness of the politicians in Washington, D.C. And you can see we are up here. We've seen this almost parabolic rise in U.S. debt. And at some point, something is going to have to give. Either we cut spending or raise taxes, maybe a combination of both. But at some point down the line, you know, we've talked about the world's reserve currency status of the dollar, fiscal stimulus, if fiscal spending is a tailwind or a headwind to GDP, at some point this is going to become a drag. And again, the takeaway here is this is very much a team approach into getting where we're at. Hopefully, the folks on both sides of the aisle can come to an agreement as we approach the date X, which is early June, for the debt ceiling. Turning the page back to 2011. So there's not a direct parallel to what's going on because the macroeconomic background are completely different from 2011 to 2023. But it's important to show this for context. So back in 2011, there was this debt ceiling debate, and the market didn't really start paying attention. So this is the S&P 500. The market didn't really start paying attention until 2 weeks before the X date. And the X date is when a deal had to come to the table. Okay. So right now we're about 3 weeks away from the X date. And as you can see from 2011, markets didn't really care. Yeah, there was some choppiness, but this is basically a straight line. If we were to draw a median line through this, the market didn't really do much. And then it suddenly dropped. The S&P dropped about 15% in a period of 2 or 3 weeks. Okay. And that actually was a bad thing, but it turned out to be a good thing because it compelled Washington, D.C. to act. So right now, other than the short-term U.S. Treasury market, there really hasn't been any signs of stress related to the debt ceiling, especially in equity markets. However, if we do get a similar drop, that is going to put pressure on Congress and D.C. and could result in a deal. So look out for this. Bad in the short term, but it could compel the folks in Congress to meet in the middle and come to a deal. So this just overlays the headlines back in 2011. And again, the X date was in early August of 2011. It turns out the important dates were a few weeks before, where both sides couldn't connect on a deal. Things got worse. The U.S. actually got downgraded in their credit rating. The first time in history, we gave up our AAA rated credit rating, which is the highest, and were downgraded a notch lower to AA. that turned out to be really a signal. There's really not a material impact on that other than the headline risk. And again, that compelled Congress to act because that had never happened before. And it really was more of a global embarrassment. In the star, the shine of the star kind of came off U.S. markets and U.S. government. So I've been getting a lot of questions about what can I do if the debt ceiling comes to a stalemate and things get worse. And I think there are several things to unpack there. And the most obvious to me is it's impossible to trade based on the whims of a bureaucrat. So back to the previous slides, the debt ceiling doesn't matter until it matters. And last time it was 2 weeks out. We're currently 3 weeks out. Right now, there's really no signs in the equity markets that they're worried about the debt ceiling. But again, that can change in a whim. And it's really hard, if not impossible, to trade based on the whims of a bureaucrat. Just because you know the likely outcome of something doesn't mean that the markets are going to react the way that you think they should. And this is a really good example of that. So what this is I added in some other asset classes. So you got the S&P 500 in orange. And what I did was just show the full calendar year of 2011. So this would be the start of the year. This would be the end. This is the S&P. And back to the previous slide, you can see the drop down almost 15%. We were up 5% here and then down 10% here. So 15% in a period of about a month. So that was a pretty dramatic move. The blue line is gold, okay, which gold went up as you would expect. I mean, gold typically performs well when equities perform poorly and there's geopolitical uncertainty or economic uncertainty. And last, this is a long-term U.S. Treasury bond. Okay, so back to my earlier comment. The market, even if you know the outcome of something, the market doesn't necessarily react the way that you think it will. I think equities make sense going down. What is just ridiculous is a long-term U.S. Treasury bond is a long-term debt obligation of the U.S. government. If the U.S. government is threatening a default, it's really hard to reconcile how investor money would pile into a long-term obligation of the entity, in this case government, that is going to default. Which again, zooming out, points to the absurdity of it all. The market really doesn't take this seriously. The market doesn't really think the U.S. government is going to default. If it did, it certainly would not buy 30-year U.S. Treasury bonds. And to flip this problem, imagine if a company, so say this was a company, imagine a company was saying, we are not going to pay our bills. On what planet would investors, rational investors, pile into 30-year bonds of that company? It wouldn't happen. It would be quite the opposite. You would expect the debt of that company to trade for pennies on the dollar. When companies don't repay loans, their debt goes way down in value. Their stock goes way down in value. The opposite is happening here. Okay? So I think you need to take this whole episode with a grain of salt. And I'll wait to come to the conclusion slide. But a lot of this is just posturing. I'm not saying things can't get worse, but I get questions like, hey, if the U.S. defaults on its debt, what should we do in the portfolio? What should I be doing? It's like, if the U.S. defaults and things go to hell in a handbasket, you're not going to be worried about your money market fund. You're not going to be worried about your U.S. Treasury portfolio. You're going to be trying to stay alive. So take that as what you will. But I think you have to understand the game that's happening here. And a lot of it is just political pandering and posturing. And of course, the media is going to make this the biggest problem on earth. They're going to sensationalize it. They're going to shove it down your throat. And I think you can pay attention, but I think you have to be aware of what's going on as well. And this is a piggyback of what I just said. So again, if the market really thought, so this is a US dollar index versus a basket of currencies. And this is 2011. This is 2011. Okay. So this is when the debt ceiling debate really heated up. This is when a deal was struck in early August. You can see there was some choppiness. The dollar did go down, but as soon as the deal struck, the dollar went back up again versus a basket of currency. So, if you were to draw a line through this, it was all a big yawn. I mean, we finished basically where we started, and in between there was a lot of noise and rhetoric about the debt ceiling, U.S. defaulting. It turned out to be a big yawn. So the takeaways. Okay, so this is the non-BS version that the news should be reporting, but they're really not. So the first one is the politicians are going to politic. Each side is going to throw nonsense. They're going to blame the other side. We've seen this movie before. It doesn't have to be a debt ceiling topic. It can be anything. They can't agree on anything, which is what you get with the divided Congress. Okay. The financial media is going to sensationalize this. The financial media wants to suck you into the vortex of nonsense. They get paid to sell ads. They want eyeballs. They want opens. They want clicks. They are going to try to make this debt ceiling problem your problem. Okay. It's fine to pay attention, but understand that everything is going to be sensationalized. The third bullet, stocks could react negatively to the drama in Washington, D.C. We saw it in 2011. Stocks sold off by roughly 15%. It seems the equity market started to pay attention 2 weeks out from the deadline. Right now, we're about 3 weeks out for the deadline. But again, it's really hard to trade on the whims of a bureaucrat, right? Let's say you sold everything today and a deal commenced tomorrow. Well, that probably doesn't end well for you. So again, make sure you have a portfolio that reflects the way that you feel about risk. Make sure that you're diversified. Historically, U.S. Treasury bonds, the dollar, gold has held up well. That was true in 2011. I'm not saying that is true today, but that could be a decent place to hide while this debt ceiling drama plays out. Some investors will panic and make emotional decisions. So I'm not saying that we're seeing panic, but I'm getting an email or two a day about the debt ceiling, and some investors want to know what they can do. Again, this is not a tradable event. It's impossible to market time or make any allocation shifts based on what a bureaucrat does. The best approach, like I just said, was make sure your portfolio reflects the way that you feel about risk. Make sure you're not leaning, reaching for yield, reaching for risk in this environment. The most likely outcome, Congress is going to raise the debt ceiling. Both sides are going to tout it as a victory. They're going to hurl insults at the other party. Again, we've seen this movie before. Long term, the U.S. will continue to kick the can down the road. Back to my first slide. This has been a problem for almost 20 years where no one wants to solve the problem. They want to kick the can down the road. At some point, the folks in D.C. need to rein in spending. They probably need to raise taxes. Some common sense needs to prevail. But again, this is D.C. where so few put their interest ahead of so many. And until we have reform, we have term limits, we have people that want to really put the country first, this is going to be an ongoing drama and fiasco. So this is quick and dirty. I'm going to shuffle back through these slides because I realized my face was hiding the source. So just for compliance, you can see the source of all my graphs. If you want to go back and pause, you can look at these. So I hope you enjoy this. I hope this distills and cuts through a lot of the noise that's out there. And if you have any questions, shoot us a note at insight@pureportfolios.com. Thanks for watching and thanks for listening. We'll see you next time.